Bookkeeping turns into accounting. Then accounting, the information that an accountant uses, the information that is given by the bookkeeper. Then the finance manager uses, or the finance team uses, the information from the accountant to make the insights about the business, if the business is going to the right direction, wrong direction, and if we really need to get a loan, a facility to be able to leverage, or grow the business. Welcome to the Accounting Show. This is Ruth Nyandoya. Today, I'd want to speak to business owners. Those people who are starting, those people who have money and they don't know just what to do about it. It's about bookkeeping. What is bookkeeping? Bookkeeping is recording every single transaction in your company. Bookkeeping turns into accounting. Then accounting, the information that an accountant uses, the information that is given by the bookkeeper. Then the finance manager uses, or the finance team uses, the information from the accountant to make the insights about the business, if the business is going to the right direction, wrong direction, and if we really need to get a loan, a facility to be able to leverage, or grow the business. That's the information that is required. So let's talk about bookkeeping. Bookkeeping is the process of recording the financial transaction of a business. Today we make a sale of 100 shillings. Then we bought raw materials at 50 shillings. We bought tea at 20 shillings. That is, we are reducing our sales. Then we bought another thing for 10 shillings. So we end up with a profit of 20 shillings. That's the information the bookkeeper will give. They are recording every tiny transaction that is happening and also checking on the compliance of the business. In Kenya, the Kenya Revenue Authority has given guidelines on how to do the transactions. For instance, if you receive a purchase invoice that you need to pay, if the purchase invoice is not ETIMS compliant, a bookkeeper will not record it until we get a ETIMS compliant invoice so that we pay for it. And why do a bookkeeper want the ETIMS invoice? They'll want it because it will help them reduce their profits even when it comes to tax purposes. So it's very crucial for you to have a bookkeeper in your business to record every transaction in the proper way, looking at the compliances with the Kenya Revenue Authority and the taxman, so that you don't get yourself in trouble with the taxman. Once the bookkeeper has done his or her job of recording the transaction, the accountant comes in to prepare the reports. The reports of the business, you need at least 3 reports for in your business. You need a profit and loss report, you need a balance sheet report, and you need a cash flow report. These reports help the business owner to understand, and the reports need to be prepared in a layman's language, because not every business owner understands the finance languages. So they are put in simplest form so that business owners can understand. And whenever they have a question, it's easier whenever they have a question, it's easier for them to ask, because of what they are trying to understand in the report. So the 3 reports, the profit and loss only shows your sales and expenses, and the possibility or the estimation of the taxes that you need to pay, because taxes are based on the profits that you make. So if the bookkeeper failed on their job by underestimated or overestimating the expenses, you'll end up paying more or less taxes. Then we come to balance sheet. So once we get we are done with the profit and loss, we come to balance sheet. The balance sheet is now showing us our assets, our liabilities, and capital that you invested in as a business owner. So it will show you invested in this company 100,000. This is how much assets you have in your business, and this is how much liability you have in the business. And it goes further and divides the liabilities in the long-term and short-term liabilities, what you need to pay within a year and what you can pay within 10 years. Then from there, you need a cash flow. A cash flow statement is now giving you the position of the company to show that are you still in business or you just close your doors and go home. So it helps you understand how much you have in investment, how much are you using in operations, how much are you expecting to receive from customers, or how much are you supposed to pay the suppliers. So that process helps a business person understand each and every bit and aspect of his or her business. From there, a finance person, a finance manager, a financial analyst would come in, look at the reports, and advise on what these reports can help the business with. If the finance manager or the financial analyst sees that the business is not going to the right direction, they'll advise for some costs to be cut. And that's why you'll find some companies will ask for redundancies. It's not that because they want these people to go. It's just business is not working. The figures of the companies are not making sense. If they look at the 1 year to come, they'll not be able to pay salaries. And if they don't be able, if they don't pay salaries, it means there's some legal cases that will start coming in from employees that these people are not paying us our salaries. So for the company to get to that position, they've already analyzed the business. And if they say, like, okay, we can keep these people, we can still continue with this project, but let's get a loan. They need to also say, if we get a loan, how long are we going to pay? Is it sustainable for this business? The money that this business is making, will it sustain this loan facility, or will we mess ourselves up? So such kind of reports are very crucial. As a business person, you don't just walk into the bank and say, I want this much amount of loan. And when it gets to worst, you default on loan. That means you default on loan, you destroy your credit score, and when you need now loan, you'll not be able to get. So as a business person, it's advisable to have the simplest bookkeeping in your company. Make sure that every single transaction is happening, and avoid, or if you can't avoid, record the money that you take from the company. Some business owners I've seen, they just go into the bank, withdraw money, they never bring it back. If you are running a limited company, you should pay back the limited company, or we just keep it in the books that you took this money, and the company you are liable to give, or you are liable to give the company this much. And if you are a sole proprietor means that you registered just a business name, like you are the business. There's no difference between the business and you. Make sure you record the drawings of the owner, or it's called the owner's drawings, so that when you get those reports, you'll be able to understand that I am the problem. I'm the one who withdrew this money from this company. I'm the one who gave out the stock, because the stock is the asset of the company that could generate you money. So you will start seeing where you fail. And next time, if you want to come and reinvest back into this business, or if you want to close it down and open another business, you'll have some lessons learned from this side to that side. Make sure the 3 reports are with you always. monthly. Management reports are being done monthly to see where you are, how much sales you did this month, how much sales you did the other month. You can compare your figures and see whether you are progressing on well or you're going down. And in the reports, it can also show you that in as much as I made less sales last month, also my expenses reduced. But in the case where you find that you made more sales and the expenses shot up, you need to really analyze that and look at a solution for that. Always keep the costs at minimum and the revenues at maximum.